Good morning, 2nd of November 2025. Today I will be telling a very important concept about what is happening in the world financial market. This chart which we see, this is United States money supply, that is M2 money supply. Many times I have been talking about M2 money supply, what is the use of it and how important it is. So basically this talks about the entire money supply which is available in the world now, and especially the United States. Now, we remember that in March 20, there was the most important event in this decade, that was the COVID pandemic. After the COVID pandemic, if you see, before the COVID pandemic, in fact, this is March 20, this is, yeah, March. So this is March 20. Now, before that, the M2 money supply, it was continuously increasing. And after it was increasing, then we saw that here, if you can see, this was a continuous increase in the money supply. Now, when it was increasing, that time all was well, but when suddenly the COVID pandemic struck, now I'll just zoom it to make it much better. Now, when the COVID pandemic struck, we can see the amount of sudden increase in the money supply. That is the M2 money supply. Now, because of this liquidity infused in the system, we saw how the stock market performed and how it went. And subsequently, it went right up to a particular time, somewhere till you can say May 22. That is this one. I'll just draw this here. Yeah. So till here, the money supply, it kept on increasing gradually. Now from 20 to say May 22, if you say that time, just note these two dates. And after that, what has happened? After that, the money supply has come down. Now, as I zoom, yeah, slowly the money supply started to fall down. It started to fall down, and now it is almost steady. Okay, so what we can learn from this? So now, if we see this dates here, I'll go to the Nasdaq, that is the American market. In fact, we can also go to Indian market, but I'll prefer Nasdaq, the 100 index. Yeah. So this is March here. This is what the COVID pandemic at this spot here, this spot here. And subsequently, because of increase in money supply, this went up right up to December, Feb, March 22. And after that, when there was a gradual decrease in the M2 money supply, slowly the markets started to fall. And then because of this fall in the market, subsequently after Jan 23, there was again a increase in the market. I will not say a big increase, because if you actually see, how do we compare? Now here, I'll take out all these lines. Yeah. So now see here, there was anyway a gradual increase, and subsequently there was a drastic increase. After this fall here, the increase is gradual. So for us, we will say, okay, wow, this increase is too much. But we have to note this market has already fallen this way. So it had to recover to this level here. That is that this was the top level. It had to recover to this level, and then from there, if we count the increase, it's this much. I hope you got my point. So this is what I'm trying to tell, that the market is slightly recovering, but it has not yet shown that boost. Now if we go again to the Federal Reserve, this is the what do you call this is the Federal Reserve system. That is the Board of Governors of Federal Reserve System. I'm sure most of you all would not even have heard about the chart. Now, this is the balance sheet of the US Fed. I keep on telling in all my groups and all my PPTs and all my lectures which I give, that we have to monitor this particular graph. Now look here. When the 2008 crisis happened, there was the balance sheet was very gradual, and suddenly there was an increase in this particular balance sheet. Correct. After this increase in balance sheet, there was a huge liquidity which was infused in the system, and then our markets did well. Subsequently, there was an up down increase, and again, you can say from 12 to 13, there again a sudden increase in the money supply into the by the American Fed. Now, this particular balance sheet talks about two main terms. One is quantitative tightening, and one is quantitative easing. What is the meaning of quantitative tightening? Tightening means the US Fed sells bonds to the investors world over. So when they sell bonds, what do the investors do? listen to the concept. The investors, they buy these bonds. So if they have to buy the bond, they give the money to Fed, and Fed in return gives the American bond. There is quantitative tightening. So what is actually happening is investors are giving their money, that is in dollar, to the US Fed. So money is going out of the system. Correct. System is what? The investors, the banks. Okay, the bonds are not only bought by the investor, they are even bought by huge, big institution, the banks, okay, the insurance companies, everyone. So that is a phase of quantitative tightening. So when quantitative tightening happens, that is, you can see there a gradual tightening in the quantitative this the US Fed. So this is a period of slight quantitative tightening, and subsequently, after the 2020 pandemic happened, there was a sudden increase. So this was basically a period of quantitative easing. Correct. See this portion which I'm going to circle this way. This is a period of quantitative easing. But what has happened after that? After that, again the phase of quantitative tightening has happened, and we can see this quantitative tightening happening. But if you see this, the last few portion, the curve which was very steep here now is slowly becoming a bit non-steep. Correct. So it means that the Mr. Jerome Powell in a December meet has told, in fact, November meet, that he plan to stop quantitative tightening. So when quantitative tightening is stopped, this particular curve will start moving this way. It will not be moving so steep. Okay, this is a portion. So this portion which we are here, see, so this is basically this phase where we are here. And slowly, when after the Jan, Feb next year, this chart will move upward this way. So I hope you have understood the concept. So this period is called a quantitative easing. That is this period. See, I'm showing here. This is a period of called as quantitative easing. This portion here, which I'm going to circle this way. Correct. So when quantitative easing happens, the US Fed buys bond from the market. So when that happens, the when they are buying the US Fed has to give now money to the market participant, that is the investor, that is the insurance company, so and so. So they give in terms of dollar. So dollar flows into the system, and when quantitative easing happens, when dollar flows, that time is the phase of the next bull run. So whoever is telling you that the bull run is over, we are going to have a bear market and all that, as per my analysis here, I don't feel that will happen. Now, and I at least feel next year should be a good, a decent year for the world market over, and for the metal index, it may not be so good. Why? Because when when there's liquidity in the market, equity market tend to rise, and metal, that is gold and silver and other commodities, they tend to come down. This is what is my take. Okay. Now there's one more thing which I usually watch. Yeah. So this is the US Fed, this is CME group. Now, this is December 25. So if you see here, the chances of a rate cut in December is basically 63%. Earlier, it was almost 90%, but it has come down to 63%. Okay. So the problem now is that November, there was a 25 basis point. December, we hope there will be a rate cut. October, there was a 25 basis point. Okay. So now we'll go to this particular window of ours. Uh, yeah, I think I don't have that now. Okay, no issue. Yeah, so whenever there's a rate cut, okay, so what will happen is that when the rate cut happens, that time the money flows into the system. So coupled with quantitative tightening, coupled with quantitative easing, there will be a very good chance for the markets to perform. So let me draw here. So assume now my drawing is slightly not so great, but let me see. Assume we have a pot here. Okay, this is my pot, and there's a tap. Okay, there's a tap. Now, whenever there's a rate cut, water flows into this pot. Correct? Because liquidity is infused in the system. So water is flowing into this particular pot. So water is getting filled up. Okay, here. Yeah, very poor drawing, but I cannot help it. Now what happens is that this particular portion is for the rate cut. Correct. But there is something called as quantitative easing and tightening concept which I have explained. So assume there's a small hole here into this particular pot. So if there's a hole here, the water will surely flow out. Even if I fill water, that is, even if I cut the interest rate, water is still flowing out. Now this portion which I'm circling now, see, this is basically called as quantitative tightening. Because of quantitative tightening, which is the selling of bond, there's a slight leakage in this particular pot. So we're not able to fill the pot with water. What Fed is told is that from December 25, they will stop this tightening. So it means they will plug this particular hole. When this hole is plugged, correct, irrespective of a rate cut or no rate cut, there will be water left in this pot, correct? And again, if rate cut continues to happen till next year, which I foresee that quarter two, the start of quarter two, that is April 26 onward, there will be a good amount of positive sentiments in the market. This particular pot will start filling up. Okay, so remember one thing. If there's so much of water means liquidity in the system, you can assume that way. If there's so much of liquidity in the system, do you expect the market to crash as Mr. Robert Kiyosaki, who's been telling since last 5, 6 years that the market is going to fall, the market is going to fall. So when it falls after 8, 9 years, he will tell, see, I told you, na, the market has fallen. Okay, so just stop all your Twitter, just stop all your TV ads, just stop everything. Listen to this concept because this is the most logical reasoning which I have done with my own study. So when this happens, there'll be liquidity in the system, and then the market should perform. This is what is my analysis. Rest, I do not know how other people take it, but let's see. Only market will tell us in the future. So now this filling up. Now see, there are two things. One is the quantitative easing. When this easing happens, this then thing is plugged and liquidity starts flowing in the system. The more the rate cut, the more water flows in the system, and then your market will surely boom. So this is what I particular feel, and let's see how the future is in store for us.